We're half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with David Ingles.
Let's get to your top stories. Today, a Bloomberg scoop. Chinese officials said to be discussing the sale or a sale of TikTok's U.S. operations to Elon Musk as an option if it fails to fend off a ban.
And another exclusive. We've learned Trump's team is looking at ramping up new tariffs month by month to boost negotiating leverage and avoid an inflation spike.
Also ahead, China's securities regulator pledging measures to stabilize these markets after a disappointing start to the new year.
Plus, we are live at the UBS Greater China Conference and Goldman Sachs Global Macro Conference with top insights into China's economy, markets and business environment.
Welcome to the show. And finally, we saw a bounce after what's a multi-day declines across generally risk assets. And certainly the question right now is, because of this retracement we've seen in both stocks and bonds, what's a better option at this point in time? It's also a story and a narrative of, almost retracing all of those gains. I think when you look at S&P futures right now and that bounce we're seeing on the cash markets, we've almost reversed all of the gains from the U.S. elections. You can also almost apply that as well to Chinese markets, which we'll get to in a moment, which have also almost retraced completely all the post-stimulus gains. Today, it's really a story of a weaker U.S. dollar on the back of that report that maybe we might see some sort of a gradual implementation of these tariffs, which, by the way, Wells Fargo, I believe, one of the brokers that have come out with a note there saying that it could actually provide a boost to the renminbi. More on that in a moment. Here, flip the boards, please, if we can. Apart from the Nikkei, I should mention, of course, which is reopening today. The story across these mainland markets and Hong Kong is we're doing better on the mainland than we are doing in Hong Kong. We are still on bear market watch for several of these other benchmarks after MSCI China entered that yesterday. As you can see, the currency's in focus today. Later on in the afternoon, we had the briefing, of course, coming through out of the PBOC and the foreign exchange regulator. Joint briefing in the afternoon. We're bookended by this vow and this promise out of securities regulator to stabilize these markets. A 30-year bond auction is on deck today. And, of course, we're focused in on what's happening in the crude markets following this, 7% pop that we've had globally over the last 3 days or so. Very quickly, where are we? Is this a buying signal? Maybe to some it is. We have seen every time you have MSCI China fall to these levels on the 14-day RSI, tactical buyers come in. The most oversold conditions on MSCI China going all the way back to about 12 months or so. So is this a buying opportunity, or do we have to wait, Rebecca, for the dust to settle and more clarity on these things, whether that's tariffs or also the Chinese offset?
Yeah, absolutely, Dave. And thinking about the eradication of that Trump bump, the parallels to what we are seeing in China today, of course, we are still watching these Chinese equities trading in Hong Kong, the HCEI, and the HSI. We're on bear market watch on both those fronts. We're sort of a couple of percent, give or take, away from reaching bear markets there. Also looking potentially at wiping out some of the gains we've seen in stimulus. Now, CSI 300, of course, has been under pressure. Really rough start to the year. We'll continue to watch all of those through today. Today, in some ways, is really about sort of authorities and how they're managing these money markets. We have, of course, this PBOC safe briefing, Dave. That's coming at 3 p.m. today, but follows on the heels of that regulator meeting talking about stabilizing markets, as well as that speech by Pang Gongsheng at the Asian Financial Forum that we were at yesterday.
Yeah, and I think it's also important to put context there because of the briefing. Whenever you hear the word briefing, investors tend to get more excited, maybe less so recently. But the fact that it's happening in the afternoon maybe tempers expectations a little bit, not during market hours. And also, we don't have the actual top guys participating in those briefings, right? So you have both deputies from SAFE and also the PBOC attending that later today as well. Okay, we're also looking at some levels to watch, as Rebecca was pointing out, right? So we did enter bear market on MSCI China. We're about 1 to 4% away from the Hang Seng Index, the Hang Seng China Index, which is extremely close. And then a little bit further than that, it takes us back to the closing levels of September 20. Speaking of briefings, this was the Friday right before that massive rally, which kicked off after that as well. So, you know what? Who would have thought we'd be within striking distance of these levels? But yet, here we are, and I guess that really underscores the point from the securities regulator that they will do what they can to stabilize sentiment at this point in time.
Yeah, really this issue of trying to stabilize markets. We've already seen them, of course, doing that in currency markets as well, but equally now thinking about equities markets going into that Lunar New Year period. We thought today was going to be a lot about sort of this money market management. It turned out, in fact, that geopolitics is really front and center this morning. Sources telling us that Chinese officials are considering a potential sale of TikTok's US operations to Elon Musk if the current owner, ByteDance, fails to fend off a ban on the app. Now, Bloomberg has also learned that Donald Trump's economic team is discussing a gradual approach to tariffs to boost negotiating leverage and avoid a spike in inflation. Our senior editor, Derek Wallbank, and tech reporter Annabelle Jewellers are with us today. Derek, let's start with you. Talk us through this approach to a gradual or staggered strategy when it comes to tariffs. How difficult is that going to be for other countries and other governments to cope with?
Well, Rebecca, what you've got to think of when you're talking about a negotiated, sort of system like this is that it is one that is designed for, possibly for negotiation, right? It's not something that would be all dropping in one spot and then everybody has to just react to the totality of it. It's one where part of it would come on and there would be an opportunity for space for discussions and, before the next one. Now, Donald Trump has not signed off on this plan. He's not necessarily been presented with the plan, but it is being worked on by some pretty serious people. Advisors on the plan include Scott Bessent, the nominee for Treasury, Kevin Hassett, who's set to be the director of the National Economic Council, Stephen Myron, nominated to lead the Council of Economic Advisors. So this is not just like some random people. These are some real individuals. One idea on the table involves sort of gradually doing hikes by 2% to 5%. Period on period, rather than putting everything on at once. And so that would have profound market impacts to do it that way. But it also sort of underlines the idea that a lot of these things for Trump are both policy and also negotiating position rolled out at the same time.
Yeah, Derek, to your point, this would have profound market implications. I mean, Wells Fargo, I mentioned this earlier on, dropped this note that the Chinese currency may perform well if that is what we find ourselves in. To your other point, the UBS saying that rolling tariffs would be problematic for a Fed that's trying to figure out really where policy should be, given where they think inflation might be because of tariffs. Derek, we perhaps have a better idea of what the options are on the table. Quite a wide array, to be completely honest. But are we any closer to really knowing what he's actually going to do?
Well, look, David, if you are somebody who has come into this space professionally in the last 4 years, what you're used to is seeing reports like this and saying, oh, okay, that's what the policy is going to be, right? If you remember back, though, further to the 4 years of Donald Trump, you will recall that Trump's advisors occasionally presented him with all manner of things, but the ultimate decision is going to be Trump's, and Trump can sometimes surprise, right? So this is a starting point. This is something that is a plan, but Trump's ultimately the decider on this. So you should expect an increased level of volatility just sort of being in the system, right? And remember that Trump is somebody who does not necessarily value certainty as much as others do, sees a lot of benefit in sometimes of this uncertainty and this volatility, and has had 4 years of sitting on the sidelines trying to figure out how to approach this term, including to what degree volatility can be a powerful asset in your own arsenal.
Derek Wallbank there in Singapore. Thank you for joining us this morning. Belle, let's turn to you. I mean, we're talking about this sort of geopolitical tectonic plates shifting here underway. Now we think about how corporates are being wrapped up into this. It looks like TikTok, perhaps the preferred buyer from Beijing's point of view, will be Elon Musk. Tell us what we know so far.
That's certainly one of the possibilities that's being discussed, and that's what we're hearing from sources. This is a Bloomberg scoop that just came out this morning. I mean, we've got to keep in mind, of course, the main priority from China's perspective is certainly for ByteDance to continue to retain control of the app. But in terms of the possibilities, yes, that's what we're hearing, is that Elon Musk's X could take control of TikTok US and run the two businesses together. What's in it for TikTok, or what's in it for X, rather? I mean, there's a couple of different things. Firstly, it could help X's efforts to attract advertisers. And then separate to that, there's an artificial intelligence company that Elon Musk also founded, XAI, and that could also benefit from the huge amounts of data that's being generated by TikTok. In terms of the valuation of this deal, I mean, again, it's really difficult to tell on a lot of different fronts. But Bloomberg Intelligence last year said that TikTok in the US could be worth somewhere between $40 and $50 billion. Elon Musk is the richest man in the world, we know, but it's still a large amount of money for him to finance, and he's still paying off X's loans as well. It's also unclear if US TikTok would be sold off in a competitive process or if the sale is going to be arranged by the government. But just going back to sort of the main thing we do need to remember, of course, is the priority or the preference for China is for ByteDance to retain control of its operations.
Have we heard from either company?
We haven't heard anything, but it's also, what else is interesting in this scoop today is it's also not clear how much ByteDance actually knows about these conversations that are reportedly taking place, and also whether Musk, TikTok and ByteDance have held any talks themselves on the terms of a possible deal. So there's a lot of different lacks of clarity in this whole story. But one of the things that's also interesting to note is that essentially ByteDance's US operations for TikTok aren't necessarily at the sole control of ByteDance either, because the Chinese government holds a so-called golden share in the ByteDance affiliate in China. That's Douyin. It's the TikTok equivalent in China. ByteDance would say that golden affiliate, that golden share would only apply to Douyin, but of course there are other export controls in place that would prevent China, for instance, or allow China to block the sale of those algorithms that are so precious to TikTok. So ByteDance doesn't really have the full say of where this goes either. So that's, again, according to sources, and it's discussions that are happening at the Chinese government level.
And it does look like now that this ban will be rolled out on January 19, potentially. Tell us a little bit about the migration that we're seeing of TikTok users to other platforms and how they're reacting.
Yeah, it's probably not what the White House would have wanted to see. Actually, if you were to take a look at the Apple US app downloads this morning, the number 1 and number 2 apps today are Xiaohongshu, which is called Little Red Book or Red Note, and that's again a Chinese app, but it's an amalgamation of Pinterest and Instagram. That's number 1. Number 2 is Lemonade, and that's another affiliate of ByteDance as well. So we're seeing a big migration now from TikTok users that are looking to go to other platforms. They're actually continuing to go to Chinese apps, at least if you take a look at the downloads, but also here what you see with Google Trends. This is the searches that are taking place for Red Note. You can see that Xiaohongshu in blue, YouTube Shorts in orange, Reels. I mean, maybe that's also just a bit of information gathering as well. People still don't really understand how these apps necessarily function, but certainly we are seeing some interesting trends underway, because that does seem to be the most likely scenario right now, is that, yes, from January 19, the app goes so-called dark in the US. You won't be able to download it on the stores, and also you won't, if you're in the US, won't continue to receive any app updates either. So that is what we're sort of looking ahead to come next week.
Belle, thank you. Annabelle Jewelers there on the latest on TikTok, and certainly the big news from just about 1 or 2 hours back here. To one piece of breaking news to another here, the land of the rising sun and the land of the rising yields here. 10 days away from the BOJ decision, the bond markets are almost forcing the hand here. So earlier on, we did see the shorter end of the curve start to hit multi-year highs. This time, it's the highest on record on the 40-year JGB. We've never seen yields at about 2.75% here on very long-dated Japanese government bonds, which I guess goes quite a juxtaposition here when you look at this and this 30-year bond auction in China today, which probably will show just the opposite, really, in terms of just price direction there. So we'll leave that and we'll table that story for now. In a couple of minutes, we'll be getting the PBO6 of the day. Plus, of course, going into the open today, you're watching the China Show. Good morning. Right, welcome back to the show. A glance at the Treasury yield curve right now in the Asia Pacific, trading early Tuesday. And you know what? 5% called you crazy a few months back. Call you crazy now? Question mark. Let's bring in Vincent Mortier, Amundi Group CIO, joining us here in set. Would you be a buyer of Treasuries at these levels?
At these levels, for a medium-term investor, I think it is becoming interesting. I mean, so we might see again the 5% level. Remember, we saw it last year for one day. So we might see this again. But as we think the US economy will have a first phase of boom and then will be much softer starting at the summertime, we think the Fed will have no other choice than to think again about quantitative easing. And therefore, the 10-year US can go back to 4% or below. So that's why, on a medium-term perspective, we are quite happy to have some duration at 4.7. But of course, you need to swallow some volatility because the volatility of the bond market has been extraordinary for the last 2 to 3 years, much more than on the equity market. Yeah. So if you are happy to have some volatility, and if you are not a day trader but more a 6 month, 1 year investor or even longer, now strategically we have decided to go back and buy duration actually at these levels.
Okay. So speaking of having the stomach for volatility, tell us, what is your strongest conviction, your biggest bets across assets for 2025? So
it's more relative bets actually, because on an absolute level we cannot say that risky assets are cheap at large. So it's more a relative view. When you see that on average US equities are trading at 3 times the valuation levels of Chinese equities, for example, I mean, this kind of gap is quite extreme. So US equities are at their 3 percentile historically of valuation. So you need to be very confident regarding the earning growth and the US policy. But you know, with Trump, we have lots of uncertainty around. So I mean, it's difficult to justify such level of valuations. So we are more in a broadening of the market, and when we find opportunities in parts of the markets which has been underinvested or underweight by investors. So China, of course, some European names, some small and mid cap in US, and we are more cautious on the mega cap, actually in US but also elsewhere, which are too expensive in our mind given all the uncertainties which are around.
I mean, the timing makes or breaks the performance of the fund, and I'm wondering, do you start to increase exposure now to the broadening out of the rally, or are you waiting for a specific trigger?
No, I mean we have entered the year slightly overweight on equities, but with some protections to the downside on US equities. So the idea is not to be invested into US equities. It's just to be aware that the risk reward starting from now is quite uneven. So you may have a 5% upside, but you may also have a 10-20% downside. So to buy some protection, so the easiest way is to buy your put options actually. 6 months maturity, for example, is quite cheap, and you protect your portfolio. Waiting, if the market is going down by 10% or 20%, you will make money on your put, and then you can redeploy money and buy back the market. So it's more a kind of tactical play, given where we are in valuation. And if the market is going up, but you will lose your option premium, but it's a small amount compared to the gain you will make on the market. So today, as you know, volatility is very cheap on equities, not on bonds, but on equities. So it's a very good opportunity, and in particular, volatility is cheap on put options, so on options to sell the market. Many people want to buy call options, so to buy upside market. So it's not very common that volatility is more expensive to the upside than to the downside. So that's why it's a good opportunity to buy such products today.
And just a word on Chinese assets here. I mean, what are you buying? What are you selling? But also, what would it take to trigger an overweight?
Yeah. So first on Chinese bonds, the performance has been achieved in a way. I mean, given where we are in terms of rates, of course we can go a little bit lower, but then the bulk of the performance, the value in Chinese bonds today is not obvious. So we are not very keen to have lots of Chinese bonds at these levels. But Chinese equities, actually, when you go to the broad market, so the A500, you have many companies which are actually profitable, growing, quite leading in their fields, competing with US companies as well, and which are, as I said, 3 times cheaper. So there are many situations that we like in this space. Of course, the mega cap Chinese can be more questioned in terms of future earning growth, and they will be the main target of tariffs, typically. But if you believe that there will be a stabilization of the Chinese market and some stimulus to have some domestic consumption pickup, then there are lots of value to be captured in these names. So at this kind of levels, I think it's a good idea to be relatively overweight Chinese equities, which is not at all what we see with our clients, to be fair. Not yet. But we have seen in September that it can be very brutal. I mean, when people are covering their shorts, the market can rebound a lot because people are very, very little invested. So technically, we can have also very good surprises on this front. So maybe China will be the good market of the year.
Okay. Maybe the good market of the year. Vincent Mortier, Amundi Group CIO there, joining us this morning. Now, just a quick look at futures before the market open. Gosh, just a touch there open. We were watching for a potential bear market in Hong Kong. Hang Seng up just a touch. And USD onshore yuan there on your screens right at the bottom, relatively unchanged so far. There is plenty more ahead. Good morning. This is Bloomberg.
Good morning. Okay, the Tuesday session just under 4 minutes away, and it's looking like we'll be taking a humble step back from the bear markets and some specific levels to watch, which we'll get to in a moment here. The big story across these markets, Chinese markets today, is that vow out of the CSRC to stabilize the markets, and might we get a little bit more from the joint briefing at the close today from the PBOC and the Forex regulator. The open is next. This is Bloomberg.
Welcome back. You're watching the China Show. We're counting down to the open of markets, Dave. Looks like perhaps we can take a little bit of a sigh of relief, perhaps, with this bear market watch that we've been on. And had a little bit of weakness in equities. Of course, a very gloomy start to the year. You know, even at the AFF, I have to say, you know, you see a little bit of optimism. People are trying to sort of look forward through some of that weakness. But it's hard to avoid just seeing so many, the MSCI China already into a bear market, really the worst for some of these indexes in a decade or so.
Yeah, I mean, the headlines are certainly not very helpful for sentiment. I think the fact that you're getting the securities regulator coming out and saying what they said is indicative really of maybe how quickly and how bad the start of the year was. And we'll get more on that with Min in a moment. The other point that Rebecca was just making there as well, I think is important, right? We now understand better what the risk to this market is because of the bounce we're seeing today, right? So yes, it's down to $1 that's softer today for the first time in 5 days. And now you got to ask yourself, why is the dollar softer? And really reports around a gradual sort of implementation of tariffs potentially on the table, you understand that that's what's freaking markets out. The uncertainty around that is driving the dollar up. Yes, there's the Fed as well, but we'll take these wins every now and then in any shape and form. Very quickly, too, let's have a look at the open in Hong Kong. And by the way, while you're looking at the 30-year bond auction today, just keep that in mind. We'll get more details on that in about 2 hours from now. Most sectors are up at the open today, as you can see. The Hang Seng Property Index, which is seeing some marginal gains, if at all, of course, has been really one. Okay, live TV, there we go. We're now down on that benchmark. Tencent annual address out. That's number one. Number two is, flip the boards, please, if we can. BYD. According to some reports, that's the last one on your screens right there, of course, might be coming out with their plans on the tariff story, their plans around Mexico. We're looking at financials as well, and you can't make this up, 6 on both, on the back of the CSRC coming out with that promise to stabilize markets. And the third ticker you see on your screens is Huashan Haitian, which is a soy sauce maker, among other condiments. That they've put out there in the market. Nothing to do with the business, but they've filed for a listing here in Hong Kong. So we'll see if we're in for, I think, something sweet. Okay, that's the stock market story for now. More on the CSRC vow to stabilize markets. Let's bring in Min Lo, who joins us right now out of the Goldman Sachs conference, of course, here in the city. Yeah, Min, what can you tell us? What did the CSRC say exactly?
Yeah, I think it's very clear now that the government priority is really to anchor market expectations after the sell-off that we have seen across Chinese equity markets at the start of this year. The CSRC really saying that its top priority is to maintain that stable and positive momentum in the equity markets. And to that end, the CSRC said it will be working with the PBOC to enhance the effectiveness of 2 structural monetary policy tools. And these are, number one, that swap facility to enable insurance firms, security firms to really tap the PBOC for funding for stock purchases. And number 2, a liquidity support facility allowing institutional investors to also borrow from the PBOC to fund stock purchases. Now, if you recall, back in September, the PBOC Governor Pan Gongsheng at that time said that the initial amount dedicated to these facilities is about 800 billion yuan, but it could be doubled or tripled if the demand requires it. So CSRC saying it will enhance the effectiveness of that. It also says it's strengthening the creation of a market stability mechanism. Now, no details on what that mechanism is, but if you recall again, the PBOC did signal that they were looking at possibly creating this state-backed market stabilization fund. We haven't heard any progress update on that. So could this be the mechanism that the CSRC is also referring to? I think we need to wait for a little bit more details, certainly something to track. CSRC also saying it's going to increase connectivity, linking Chinese equity markets with global markets better as well.
Bloomberg's China correspondent Min Lo there with the very latest and closely watched, moves that the authorities are putting forward to try and stabilize markets here. But time to head back to the UBS Greater China Conference in Shanghai now. Our chief North Asia correspondent Stephen Engel is there with our next guest.
All right, Rebecca. Obviously, we're here at the UBS, the 25th anniversary, I might add, of the Greater China Conference here in Shanghai with our next guest, our longtime friend of the show, of course, is Wang Tao. She is the head of Asia Economics and chief China economist and new author of this book, Making Sense of China's Economy. That's what we're all trying to do. It's a lifelong pursuit for both of us, right? Yeah. So what kind of sense are you making of the current state of the Chinese economy as we enter 2025?
Right. Well, at this moment, I think there are some positive signs of some areas of growth rebounding. For example, in retail sales, because of the government's policy on trade-in programs, exports remain.
Sorry, I'm going to jump in. That has had material impact. I mean, trading in white goods and things like that. You think that's been successful? We heard that last March at the NPC when they said that's going to be our solution to the lack of consumer demand. Has it really helped a lot?
It has helped retail sales in white goods, in automobiles in the last few months. Of course, the question is how sustainable that is. Right. So I think that's always been a debate. But certainly the data since October, September, retail sales has been pretty decent. Of course, also the government's effort in putting money for local government spending has helped. And also property sales have rebounded in the last couple of months. So all this suggests that at the moment, and also in the fourth quarter of last year, the momentum has rebounded from the bottom of second, third quarter last year. So at the moment, I think there are positive signs. The question is, of course, what is ahead? There could be challenges or downward pressure coming from outside, from inside.
So looking backwards, we're going to get the GDP numbers, the fourth quarter on Friday, as well as other eco data for December. It will probably look better because Xi Jinping himself has said the growth rate is going to be around 5%. So stimulus helped that we got in September?
The stimulus definitely helped. As I mentioned, I think property sales, retail sales, and then exports resilient, and local government spending was no longer cutting. There's been a big fiscal impulse coming in the fourth quarter. That definitely, we are looking for fourth quarter GDP, quarter on quarter, 7% or more. Year on year, maybe somewhere between 4.8 to 5%. So for the year, we're looking at close to 5%, maybe 4.9 or so.
Is there some promise fatigue, though? I mean, a lot of participants want to see more stimulus outlined, specifics. We didn't get it through the Central Economic Work Conference. We didn't get it through the third plenum. So I guess we're waiting for the National People's Congress in March. Is that correct?
So I think the Economic Work Conference in December basically sets the policy stance and sets the objective. And that's really an outline for guideline for the different ministries to work on the specifics. So we are going to get the specifics at the March NPC, and we are expecting more policy support.
Like
bigger fiscal deficit. We're looking at deficit of 4% or so, and 2 trillion RMB of special treasury not included in the deficit. Special local government bonds, 4.5 trillion, 5 trillion. So in total, we're looking at more than 3 trillion RMB of extra bond issuance, and so that's a more sort of expansionary. The 10 trillion debt swap earlier, that's not really expansionary. It's more anti-contraction policy. We're going to have more rate cut, and also I think better implementation of the property destocking program. Yeah.
Do you think they've arrested the fall in the property market?
I think it's too early to say, even though I did mention that property sales are rebounding in the last 2 months or so. But how sustainable is that? Is that just a release of some pent-up demand at this moment? I think it's too early. Our view is that it will probably take a bit longer unless they implement the destocking program more effectively and quickly. We have seen very slow progress on that front.
How much of a situation does Pan Gongsheng have at the PBOC? Whereas yesterday he was at the AFF and he talked a lot about making sure that the yuan is stable. I mean, obviously, they don't want to have the outflows associated with a continually weakening currency. But at the same time, yes, exports did pick up the numbers that we got this week. But again, from the United States, it might be because of their, front-loading some orders ahead of Trump tariffs. But wouldn't a weaker currency help China lean on its strong pillar, exports?
I think obviously the currency, the RMB, is going to face a lot of pressure, both because of potential tariff, but also because of the strong U.S. dollar, right? The U.S. data is coming in strong. The yield in the U.S. dollar has moved up. All the currencies are kind of depreciating against the dollar. So I think it's difficult for the RMB. However, I think a weaker RMB may not really help or a depreciation against the dollar may not really help China's exports that much. One is that China is already a very big exporter, and if there is trade barriers, the people are already complaining, and if China depreciates the currency, other currencies, the competitors could also depreciate, so it's not very helpful. So I think Chinese authorities are going to try very hard to slow the depreciation and make sure it's only modest. But I think the trend it may be very difficult to turn in this kind of broad environment of strong dollar and potential tariffs.
Well, let's talk about tariffs. What's going to be the net impact on the Chinese economy, struggling to get footing right now in a really difficult time, and a difficult start to the year as well?
Yeah, so on the tariffs, we heard all kinds of things, and so there's a lot of uncertainty. In our baseline forecast, we have an assumption that the announcement will come in quite quickly, but the actual implementation may start in the third quarter in a phased-in manner on China. So
it could be month to month. We're hearing a Bloomberg story today.
Right.
It could be 2% this month, 2% the next month, and amortized out over many, many, many months.
That's possible. So there are many scenarios. We chose a scenario, basically 60% tariff hike on a quarter of the products, sometime in the third quarter, and then the next batch in January 26, and so on. Basically, we think the U.S. is going to adopt an approach that hurts, China's exports, but try to reduce the inflationary impact on the U.S. economy, and also give U.S. companies time to adjust, and give consumers time to adjust. There's various scenarios one can play out. That's the difficulties, but I think the one clear thing is that I think China's exports will be hurt by the higher tariffs. More importantly, corporates operating in China is going to adjust their capex spending, their hiring, and so on. So there's going to be spillover effect on the domestic part of the economy.
How are authorities going to change the dynamic of deflation? It's been 27 consecutive months now of factory gate deflation with no end in sight. CPI is just 0.1% right now. There's no panacea, but what must begin?
Well, I think the authorities, a big boost to try to stabilize local government financing situation and boost the property market is a good beginning. To complement that, they need a bigger stimulus, and we're expecting some in March. I think also throughout the year, I suspect the government will look at the economic development, look at tariff announcement and responses in the economy, and potentially announce more. So basically, I think they need to work hard to stabilize the property market and boost domestic consumption.
Yeah, March buys them a little bit of time. The inauguration will happen in 6 days, actually, and then they can see what's going to be the direct impact and how large and when those tariffs might be implemented. Right. Wang Tao, thanks so much for joining us. Congratulations on the book again.
Thank you.
I'll give it last plug. Making Sense of China's Economy.
Thank you so much.
I highly recommend it. Thanks a lot. Thanks for having us. All right, send it back to you from the UBS Greater China Conference here in Shanghai.
Thanks, Steve. Yeah, that was Wang Tao, head of Asia Economics and chief China economist at UBS, making sense of China for us. And there'll be plenty more ahead from the second day of that UBS Greater China Conference coming up. Now, the chair of industrial firm Sunresin joins us to discuss plans to expand their lithium extraction business, and we get the latest on doing business in China with AmCham Shanghai. Those are some of our exclusive conversations in the next hour.
Yeah, just to also briefly update you guys here on some of these moves in the Japanese currency. There we go. And of course, what happens here tends to have an after effect across other currency markets. As you can see, we're weaker compared to a few minutes back. And we're tying this down to some comments coming through out of the deputy governor, Ryozo Himino, there. And to talk as well, in 10 days, we have the BOJ meeting. And might this is a question mark, might this be one of the first major signals that in fact is a live meeting? But certainly you get a sense from the way JGBs have been trading. It is, in fact, a live meeting, whether to raise interest rates or not next week. Plenty more ahead. This is Bloomberg.
President Biden's national security advisor, Jake Sullivan, is warning of severe consequences if China launches a cyber attack that causes physical destruction in the U.S. He told Bloomberg that the U.S. has evidence that China is preparing for such an attack and that deterring it should be a priority for the incoming administration. Take a listen.
China is hacking the United States. There's the espionage part of that, like Salt Typhoon, and then there's the potential that China would actually use cyber means to physically disrupt or destroy critical infrastructure in the United States. And we've sent a clear message to China's leaders that if they did that, if they actually took a physically destructive cyber attack in the United States, that there would be severe consequences.
Now, Japanese drug maker Takeda Pharma says that business in China is growing fast. But the CEO, Christophe Weber, told us that these growing, to the point we were just making there, geopolitical risks have deterred the company from expanding there a bit more aggressively than otherwise.
Well, we'll see what happens. I hope that healthcare or pharmaceutical will remain protected from geopolitical tension or tariff, because innovation in healthcare, in pharma, come from many different countries, many different biotechs. So if you start to have geopolitical tension or tariff or no access, it means that some medicines won't have access and patients will suffer. So my plea is that pharmaceutical healthcare should stay away from any geopolitical tension or tariff.
Well, we should find out soon enough there. See. And I have about time for one question left with you. And I want to talk about what you're doing in China, because you've been aggressively partnering with Chinese biotech companies. And you think about the U.S. and the Chinese relationship, a lot of concern, a lot of questions over what that will look like under the second Trump administration. Could that give you any pause when it comes to that strategy?
So there is more innovation in China. It's still limited compared to the US, and we should actually remember that 80% of the new medicines in the world come from the US, so this is something very important. We are growing very fast in China, but because of the geopolitical risk, we have been very careful not to have any dependency on China. So in case there is a bigger tension, we will not be impacted. So that has been our strategy.
That's Takeda Pharmaceutical CEO Christophe Weber speaking to Bloomberg at the 43rd Annual JP Morgan Healthcare Conference in San Francisco there. Now, there is plenty more ahead. Stay with us. This is Bloomberg. Some other news from China this morning. Mexico's President Claudia Sheinbaum has announced a plan to reduce the country's imports from China. It includes offering incentives for nearshoring, tax deductions, and increasing local content of goods made in Mexico. The goal is to more closely align with trade partners, the US and Canada. And the Philippines has filed a diplomatic protest against what it alleges is Beijing's continued illegal activities in the South China Sea. Manila's Maritime Council says the Coast Guard has deployed assets to challenge 2 Chinese Coast Guard ships, which were detected this month near the Scarborough Shoal and nearby coastlines. And Apple's iPhone sales fell about 5% globally in the final quarter of 2024, hurt by underwhelming upgrades and competitors making inroads in China. Counterpoint Research says Apple's global market share slipped 1 point last year to 18%. Separate IDC data offers a similar picture, giving Chinese smartphone brands their best combined quarter on record, taking 56% of global sales. And we're looking at a couple of Chinese supplier stocks today, Dave.
Yeah, typically we do see some reaction across some of these names on the back. If indeed, of course, we get something out of Apple. We are seeing that across some names today, not all, but it's certainly a conversation worth having because of just, well, for one, the pullback we're seeing in U.S. equity markets, this tussle between Apple and NVIDIA at the very top, of course, and what that really means for the entire supply chain in the region. I think one of the other things we haven't touched on as well is, what is the what is the tariff angle to all these shipments coming through, right? Because if it then becomes something that is gradual as reported, then does that actually incentivize these companies from front-loading even more some of their shipments ahead of that? Not to say, of course, that Apple's supply chain is directly impacted by that, but it's certainly a conversation that we've seen from trade data from the time of the elections across the region. Right. Trade flows have actually picked up because in anticipation of tariffs.
Yeah, we're already seeing this massive amount of front-loading, nearly $1 trillion for China, really in response to this anticipatory effect, just trying to stock up ahead of these tariffs that might come through. And geopolitics has really dominated, all of trading so far this year. Of course, we had the tariff overhang and Trump coming through. We're in limbo before the MPC, but also we had that blacklisting of Tencent and CATL. It just underscores these sort of unexpected geopolitical rifts, these corporates that cannot avoid getting caught in the crosshairs here.
No, not at all. And I think you make a very good point. The fact that the Tencent story even happened, and as a trigger, I would even say the pullback in Tencent is actually what drove and what dragged Chinese markets into a bear market, just because of the weighting of that stock there, really underscores the immense risks and some of the uncertainties that we don't even know what to think of as it pertains to this.
Most people by surprise. We had sort of a few hours where traders were basically just bemused by what to make of this.
Yeah, is that, I think one of the jokes that was out online as well, does someone from the Pentagon not really like Dungeons & Dragons, I think is one of the games as well. Not a big fan of the game. Tencent, of course, has been buying back stock since that day. Equity markets are looking like this. We are seeing a bounce across cash markets in Greater China. Plenty more ahead here on shows. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300. We're about half an hour into the session here, just up a touch, just shy of 1%, in fact. We were kind of wondering if we were going into the day with a slightly bearish tone, but actually, Dave and I were proved totally wrong.
Yes, as is usually the case.
The market has taken a beat, and, well, let's see if this continues.
Yeah, I mean, it did look somewhat oversold when you look at some of the technicals. And then, of course, you have some of the policy puts that might be kicking in, if not already.
Right.
There's certainly speculation of that, with the CSRC basically telling us, well, quite frankly, that they will do...
Relax a bit.
Yes. Chill.
Yeah.
Take a chill pill. Wait for the measures to kick in. I think it was also the message from the PBC governor yesterday, where we were at the AFF, right? So him talking to an international audience and basically saying, we're doing many things on multiple fronts. Wait for things to take effect. 1% up on MSCI China, to the point we were making earlier on. 14-day RSI on that specific index actually was at 27, which is a level we haven't seen in about 12 months or so. So technically, could remain oversold for a long time, of course, but it was also a level at which tactical buyers came in previously. Okay, the look across the Asia Pacific is, let me caveat this, slightly misleading today when you look at it from a benchmark perspective. So we are unchanged, because a lot of that has to do with the fact that equities in the region are mostly tracking the bounce on Wall Street, and as you can see, futures are up 0.3% in S&P. But the drag from the Nikkei that's reopening today and the catch down there is effectively offsetting the gains we're seeing elsewhere in the region. It's certainly a weaker dollar story, which obviously helps. 0.25% down on the Bloomberg Dollar Index, first time in about 5 days or so, which is helping really broader Asia FX, with the exception of the Japanese yen, which we can get to later on following comments there from the deputy governor. In fact, just on that very note here, Japan is entering the last 30 minutes of trade. Nikkei topics, dollar yen, as we mentioned there, Japanese 10-year yield, the Japanese 40-year yield, if we have time to get that up, please, as we can. Some of the headlines coming through here, highest level here since inception, since the debut of the 40-year bond back in 2007, 2.76% is the yield on that. And the reason I bring that up is, might we be sleeping on a potential move from the BOJ next week, in 10 days from now. There's a 30-year bond auction today coming through out of the CGB markets. Do we have the 40-year bond? No. It's coming. Okay, it's going to come up in a couple of seconds. There we go. Thank you so much. 2.676%. Mark Ranfield joins us right now out of our MLive team. Mark, we'll get to the Japanese angle in a moment, but I want to ask you about rolling tariffs. If that is the case, UBS says it would be, and as we try and figure out what the path of the Fed's going to be, it would be problematic for the Fed. What's your take?
Well, the Federal Reserve has to deal with data which is essentially rolling anyway on the US economy, so it would just be another part of the data that they have to deal with. If you think back to 2018, 2019, all the tariffs that were introduced on China were pretty much abrupt. They were done on the hoof, as it were. There was no great plan. This month we're going to do tariffs on China at this percentage. In 3 months' time they're going to be that percentage. They just came and went as the US administration under Trump at the time wanted to do it. And markets had to deal with it. The Federal Reserve had to deal with it. So rolling tariffs, there might be nuances that they're slightly different. They might be more precise in certain ways. But the end result is the same. Prices will go up. There will be more effects on financial markets. The Federal Reserve will have more information to throw in with its inflation numbers, its jobs numbers. It'll all be part of the general growth picture for the United States. It's not as if they've never dealt with it before. I don't really think it's that much difference to them. From the market's point of view, what it might do is it might bring a little bit more short-term volatility. If it's going to be a question of things that are going to be fed over a period of time, you may get pockets where certain days are much more volatile than others. But that's pretty much what we deal with anyway. And that's what people are largely expecting. Once Trump gets into the hot seat next week, people will be expecting a deluge of messages and unpronounced things that will be coming one after the other at any time of day. That's just life under Donald Trump.
Mark, talking about that deluge of news that we're going to expect next week, I mean, tell us a little bit about how investors are expecting the PBOC, the CSRC, Chinese authorities writ large to respond. On the one hand, we know that Beijing tends to sort of like to wait things out and see how things transpire. On the other hand, we had this PBOC safe briefing today. We had that Pan Gongsheng speech yesterday. We do seem to have a flurry of messaging coming through.
They're trying to keep up a positive narrative, which they started back in September. And you've seen they had some success. They've got people back in the stock market. Some of those gains have been given up, but still the markets are slightly higher overall. There's a little bit more optimism that China's various stimulus measures will work out this year, that the economy will do better. There'll be the focus is into the areas such as consumerism that will again propel the economy a little bit forward. The general sense is that Chinese authorities are getting a better idea of what is needed to improve the economy and get investors back into their markets. But it's a slow process. It's not going to happen immediately. A lot of them are medium-term measures, and they're testing the patience of equity investors along the way. The PBOC was seen as being one of the most positive forces in this whole story. So the more the PBOC is engaged, the more investors seem to like it. But for the briefing today, expectations are not very high because the PBOC is only sending second-tier people. They are not sending the governor, apparently. So that means that whatever's going to be announced is probably not that big a deal. And it's also being done at the close of the market, which again suggests it's not going to have a huge impact. We might be surprised, but if you look at the previous big statements from the PBOC, they were done during the market hours, and we got an initial bump in the market straight away. We may not get that today.
Okay, so Mark, maybe to your point, this might be something that we may not devote too much mind space to. What about these lines coming out of the BOJ? Are these a big deal, or can I ignore this like my ex?
Well, I don't know how frequently your ex gets in touch, but you can probably look past most of the BOJ comments here. They're essentially, Mr. Himino today is essentially repeating everything that Mr. Ueda said just a few weeks ago. There's nothing new here. What he's talking about the fact that they will discuss an interest rate hike or a pause at the next meeting. That was expected anyway. One person already voted in favor of an interest rate hike back in December. So it's obvious that they would need to discuss such a matter. Plus, they've been signaling that they're watching data which they hope takes inflation to the right place, wages will go to the right level, eventually they will be there in order to raise interest rates. The way it sounds at the moment, and the market doesn't seem to be giving much chance of a January hike, probably the best they can do is to set up March, to make March seem like a live meeting where the Bank of Japan will be ready by then. They'll have what they think is sufficient data, and they may be able to go ahead with raising interest rates. Right now, it looks very unlikely that they will move next week.
Bloomberg MLive strategist Mark Cranfield there for us in Singapore. Now, up ahead, industrial firm Sunresin joins us from the UBS Greater China Conference on the company's plan to expand its footprint overseas amid a challenging environment. This is Bloomberg.
Welcome back. You're watching The China Show. We'll take you straight back now to the UBS Greater China Conference taking place in Shanghai, and our Chief North Asia correspondent, Steve Ingles, is there with his next guest. Steve.
Hey, Dave. Yeah, this is the 25th anniversary of the UBS Greater China Conference here in Shanghai, and one of the great opportunities we get, and I've been covering it for many years, a couple of decades at Bloomberg News, is to meet a cross-section of businesses from China, including small to medium-sized enterprises led by this guest now. That's Yuejing, Ivy, as you're also known. Thank you very much for joining us. You are the chairman of Sunresin New Materials. So tell us very briefly, what does Sunresin do? You create these polymers, these resins for adsorption that can be used across many different industries, correct?
Yes. Sunresin New Materials is focusing on the new material, polymer materials. We call it the application of this new materials is about separation and adsorption technologies.
So the separation, I mean, you provide solutions everywhere down to food and beverage like apple juice, right?
Yes.
As well as wastewater management and the like, right?
Yes.
You're also like a small to medium-sized enterprises. How would you describe the business environment right now for a small to medium-sized enterprise like yourself in an economy that is sort of struggling right now?
Yeah.
What are the biggest challenges you might have?
Of course, the biggest challenge is the production. Our applications covers 6 sections of markets. Just now you mentioned the food and beverage. We call it the food industry. Another one is water treatment and even metal extraction and chemical engineering, very wide applications. But for this applications, we have some existing market, and also we have some new created, expanded market. So we need to make the existing market, we get more and more market share, and the new market we need to grasp, to develop more technologies.
You've been profitable. How is business right now as you start 2025?
The business I think it's quite good. We, from the sales, the profit, and the market cap, we increase about 10 to 15 times since.
You talked about new markets or new products, new services, right?
Yeah.
You want to go into that. One of them is lithium extraction. Yeah. Lithium is a global phenomenon right now because of the EV industry and the battery industry. Producers are trying to find cheaper, more environmentally friendly ways to extract lithium. China is one of the biggest producers of lithium, along with Chile and Australia. What kind of solutions are you developing in DLE, direct lithium extraction, that could potentially have global ramifications?
To this question, I think this is about the 2 different markets of Sunresin. This one is called the increased, newly developed market. Lithium extraction belongs to the section of our metal extraction section business. For this kind of technology, we developed our own technology, to make the lithium extraction to be industrialization.
Yeah.
And we sell the whole the technology together with includes the materials, the service, and the one-stop solution to the customer.
So it's not just selling resins or selling product. You're selling solutions.
A whole package of solution. We call it one-stop solution.
So how do you become a Chinese small to medium-sized enterprise and then get the larger contracts from an Exxon or others who are trying to, I know Exxon has, identified some lithium reserves in the United States, some 10,000 feet under Arkansas. They're looking at new technologies to extract that. How does a Sunresin, a small to medium-sized enterprise in China, get on their radar and get those business? 20% of your sales come from overseas.
Yeah, sure. I think we should look at some basic elements for that. First of all, we have the very good technology. For example, Exxon. If they are looking a supplier of a new technology provider in the globally, they will look for a best supplier. So at first we have the best technology for the lithium extraction. The second one is Sunresin is not only a small listed company. We have a comprehensive capabilities to support, to provide the solution technology to the giant company. The comprehensive capabilities means we have the team, a strong team. We have the R&D support. We have some successful reference to support to give to set up next production line.
So how do you plan to grow that overseas revenue, the revenue that comes from outside of China? China is slowing. China has other lithium capabilities and extraction capabilities. But how do you how do you want to grow that international business? Because you're cost effective, but you're also cleaner, your technology.
Yeah. And most of all, the best technology is the first one. Yeah. Then we have the capabilities to support, to give the transfer the technology to the end user, to the customer. And also we can make sure we will get the result for the customer.
Ivy, thanks so much. Your stock code is 300487. You're listed in Shenzhen. The stock is up 30% since the end of July of last year. So you're doing something right now in an economy that is slowing, but you have the products for the international market as well. Thank you very much for your time on Bloomberg Television. Ivy Gao of Sunresin New Materials. Sending it back to you from the UBS Greater China Conference, guys.
Our chief North Asia correspondent, Stephen Engel, there with Sunresin chair Gao Yuejing in Shanghai. And stay with us because Steve will be back and he will be speaking exclusively with the head of the American Chamber of Commerce in Shanghai, Allan Gabor, to discuss business prospects as Donald Trump prepares to retake the White House. And a look at some of the corporate headlines we are following this morning. Apple's iPhone sales fell about 5% globally in the final quarter of 2025, hurt by underwhelming upgrades and competitors making inroads in China. Counterpoint Research says Apple's global market share slipped 1 point last year to 18%. Separate IDC data offers a similar picture, giving Chinese smartphone brands their best combined quarter on record, taking 56% of global sales. Bloomberg has learned that Honeywell International is poised to proceed with a breakup after pressure from activist investor Elliott Management. Sources say it's planning 2 publicly traded companies, with one focused on automation and the other on aerospace and defense. We're told it may announce the plan with its fourth quarter earnings in February. And Bloomberg's been told Cleveland Cliffs and Nucor are looking at a joint offer for US Steel. The Cliffs CEO confirmed his interest at a media event and later told Bloomberg he'd fund the deal using debt. A source says the partnership could include Cliffs acquiring most of US Steel, while Nucor took its mini mill assets. Shares of all three companies jumped on the news. Stay with us. This is Bloomberg.
I implore everyone to not disable the messages on your phone. This is extremely frustrating, painful, and scary, but these alert tools have saved lives during this emergency.
Now, on the story here, residents in Southern California are being asked to stay alert as the region braces for a second week of fierce winds whipping up. Of course, these wildfires have already killed at least 24 people. Bloomberg Intelligence says insurance claims caused by these LA wildfires on your terminal map go to take us through, just give you a visual of really where these things are currently. $20 billion is a figure out now. Lead APAC insurance analyst Stephen Lam is here with us on set to talk us through this. And so apart from the Stephen, obvious destruction here, what other factors are driving, I guess, these insurance losses here?
Yeah, David, I think the most horrifying scenes that you're seeing right now comes from a combination of strong winds that we're expecting for the rest of this week, basically. I mean, you're talking about hurricane force wind, close to hurricane force wind, they're happening. So these makes the rescue work very, very challenging. I mean, those firefighters have been on the ground, you know, for a week already, right? So that's number one. And number two is actually where the damages will come from. Is it coming from more from Eaton or from Palisade? Because those average home costs is actually quite different, right? We all know that the Pacific Palisade area is much costly in terms of rebuilding and the home prices. So those are the two main factors that we're looking at right now. And, you know, in terms of the estimates, I think you're hearing some are as high as $30 billion for the industry, right? So to put it into context, right now, in terms of number of structures destroyed or affected, you talk about 12,000 to 13,000. It doesn't take too much more. You know, it only takes about up to 14 or 16,000 structures destroyed. Then you can hit the $30 billion.
Okay. And thinking a little bit more about the exposure of insurers here, I mean, tell us what kind of exposure Japanese insurers are facing when it comes to these wildfires.
Yeah, Rebecca. So overall, the industry is trying to step away from Cali fires exposure. That's a general concept. For the Japanese, they are about 3%, we estimate. You know, we're talking about the Tokyo Marine, the MS-80, and Sompo. The earnings impact will start to hit and start to bite when the industry loss goes above $20 billion. That's their base case scenario, because their budgets right now can typically afford about 15 to 20 billion in terms of the fire losses for this particular season. And so if that goes to 30 billion or so, we're talking about sort of mid-single digits hits in terms of their net profit for fiscal 2024.
Bloomberg Intelligence lead APAC insurance analyst Stephen Lam there. Now, in some world news that we're tracking today, South Korea's Constitutional Court will begin hearings on whether to uphold President Yoon Suk-yeol's impeachment and have him permanently removed from office. Yoon's lawyers say he won't attend the hearing over safety concerns, and a final ruling isn't expected for months. Meanwhile, investigators have asked Yoon's security team to cooperate in the safe and peaceful execution of the warrant for the president's arrest. Now, Greenland Prime Minister reportedly says he wants closer ties with the US, highlighting the Arctic island's push for independence. His comments to a local broadcaster come after Donald Trump repeated his ambition to take control of the self-ruling territory of Denmark. That's home to 57,000 people. House Republicans have introduced a bill to begin negotiations called the Make Greenland Great Again Act.
Okay, now I'm just trying to figure out what the letters there would be for that. Tourism-related stocks in focus today. Two pieces of news here. One is you have this potential policy support push that might benefit the industry, perhaps some vouchers here to aid spending. The other one, and you see it quite visibly on this board right now, the other one incrementally is perhaps this note out of Morgan Stanley upgrading some Chinese airlines, which, as you can see, outperforming the broader tourism sector as a whole. In a really an up-day story, we're up 1% now in the Hang Seng Index, about 50 minutes into the session here. Pharma stocks in focus too. Flip the boards, please, after this pledge to support and back innovative drugs here. So we're looking at, officials here vowing to continuously adjust the country's catalog of medicines, of course, covered by what then go into insurance coverage. And let me just wrap things up by a look at bicycle-related stocks, or bicycle makers, really. We haven't talked about this story at the moment here. And this is, let me just bring the story up, e-bike makers on the up after Citi talking about these new guidelines on the industry may benefit local equipment producers. Rebecca.
Yeah, this is interesting. I mean, of course, it fits into this broader theme of sort of industrials and so on coming back through. Of course, we have these new energy emphasis and, of course, this consumption. But, yeah, interesting. Did you ever take an e-bike in Beijing?
Always, yes, every day to school, in fact.
Me too, yes. Ubiquitous. Plenty more ahead. Stay with us. More on e-bikes. This is Bloomberg.
If you exempt the goods where China is dominant, so in our forecast, we exclude 25% of all the goods where you have no ability to buy anything else, that greatly lowers the inflation impact, right? So if you do across-the-board tariffs, it's much more inflationary than if you start to exempt the things where you have no alternative.
What's paradoxical is that some things do flourish. You know, electric car is flourishing, for example. There's a lot of innovation and entrepreneurship. So some things flourish, other things don't flourish, but I think the big picture would be, yes, it's very hard to have an inclusive, innovative, entrepreneurial economy when you have this kind of power structure in society.
We're more in line with consensus on China, 4.5% growth. We do think there's going to be an impact from the tariffs that we just discussed.
Also, throughout the year, I suspect the government will look at the economic development, look at tariff announcement and responses in the economy, and potentially announce more. So basically, I think they need to work hard to stabilize the property market and boost domestic consumption.
Some of our guests there from the UBS Greater China Conference and Goldman Sachs Global Macro Conference with their thoughts on tariffs and the Chinese economy.
Yeah, really, as that's taking place. Interestingly enough, a lot of support promises maybe boosting this market today, and of course later today we have the PBOC safe briefing in the afternoon to look forward to. That's a question mark. But as you can see, cash markets are doing very well in the first 60 minutes of trade. Okay, so we're sandwiched between two banking conferences taking place, one in Hong Kong and, of course, one on the Chinese mainland. We'll head it straight back now to, I believe, the Four Seasons Hotel. That's where the Goldman Sachs Global Macro Conference is taking place here in the city. And Min Min, our China correspondent, is standing by with her next guest. Min Min.
Hey, David. Yeah, we have the perfect guest here to discuss the outlook on the Chinese economy. Michael Pettis, finance professor at Peking University. Michael, so great to see you here in Hong Kong. And I want to start with what I think only you can tell us, because you've lived there for more than 2 decades. I'm very sad to hear, by the way, that your usual weekly intellectual discussions about Chinese economy with your students and bankers, that has stopped, which I guess also tells us something about the Chinese economy. But what, in your opinion, is perhaps least captured by the macro data, and what are people on the ground actually feeling about the economy?
Well, it's interesting because sometimes when you live in a place, you don't see the changes take place. But I speak to a lot of people who visit every 6 months or every year or so, and they all tell me the same thing, that there's a feeling of depression, a feeling of nervousness that is very, very evident and very different from the feeling 4, 5, 6 years ago when there was a sense of unlimited potential. That seems to have changed. Hopefully only temporarily, but it certainly seems to have changed.
Okay, and I want to talk about what I think is on a lot of investors' minds for China, which is the policy put this year. Between now and the two sessions, for example, later this afternoon we have the PBOC and SAFE coming out with a press conference. What do you think between now and two sessions is the government going to do to stabilize market sentiment, and to what extent especially do you think is the government prepared to defend the yuan after Trump gets inaugurated?
Well, in terms of policies, the real issue is not whether China has the spending ability to expand fiscal deficits or to expand monetary policy. It definitely does. For how much longer, I don't know, but for now it does. The problem in China is not so much that they haven't been spending enough, but they've been spending on the wrong part of the economy. So the China team from the IMF were in town last week, and I met with them. And they told me that their estimate of what they call the augmented deficit, the real deficit of China, is something like 13% of GDP. Now, when you have a deficit of anything close to that number and generating only nominal growth of maybe 4%, no one can accuse you of being skimpy on spending. The problem in China is the spending is on the supply side of the economy. So it's mostly more investment, more support for manufacturing, etc. Whereas China's problem is clearly on the demand side. So for me, the question is not will they continue easing, will they continue expanding fiscally? For me, the question is will they start shifting some of that from the supply side of the economy to the demand side? And so far there's a lot of talk, but there haven't been any real numbers.
And what do you think is preventing the government from actually shifting the priority to the demand side, even though they keep signaling that that is a priority for them?
Yeah. Well, you know, many people say it's ideological. I'm not sure that's the case. I think that it's a much older problem, and that is for 30 years, 40 years, you've built China around a whole series of transfers, from direct and some hidden transfers, from the household sector to subsidize investment and manufacturing and production in general. And as a result, that's what the institutional structure of China is able to do. You know, we think that it's very easy to increase income and demand on the household side, but we forget that the US and Europe have been doing this for decades, so they have an institution in place to do it. In China, it's quite difficult. First of all, national government expenditures don't go to the household sector. They have to go through the provincial governments, then through the municipal governments, and then to the households. And there are many opportunities because local governments are so strapped for cash. There's many opportunities to divert some of those funds into other areas. So the real problem is not that they don't want to increase the demand side. The real problem is that they don't know how to do that without incurring costs on the supply side of the economy.
Okay, that's very interesting. Let's talk about the two sessions, because there's been a lot of reports suggesting that the government may set a target of around 5% growth again this year, even though consensus forecast is below that. Right. I believe Goldman Sachs forecast is 4.5%. What do you make of that government target? Is it too ambitious?
It's too ambitious in the sense that the economy isn't really delivering that kind of growth. But it's not too ambitious in the sense that they can't achieve it. As long as they have debt capacity and are willing to borrow and spend, build more unnecessary bridges, more empty factories, etc., they can get any GDP number they want, which is why I always assumed that they were going to hit this year 4.9%, around that level, because they can do so. The problem is that that's not healthy growth. That's what the Hungarian economist János Kornai calls soft budget constrained growth. If you don't have to worry about going bankrupt, you can keep spending money forever on things that make no economic sense. And I think that's the problem in China, a lot of non-economic spending to generate the kind of economic activity that they want.
Right, and correct me if I'm wrong, you're of the view that the bulk of the stimulus we have seen so far last year, a big part of that is dedicated to tackling local government debt. But you're of the view that 10 trillion yuan is not really effective.
Yeah, what that really does is it's indirectly a stimulus. The purpose is to shift all of the hidden local government debt onto the balance sheet, which is a good thing. You need to know where the debt is and how much debt you have if you're going to resolve it. The stimulus impact is really that it lowered the interest rate costs a little bit. But there are two problems with that. Problem number one is that the total amount of savings was so small that ultimately, even if they were correctly spent, they really wouldn't matter. Problem number two is that when you lower interest rates, you lower the revenues for the banking system, because it's mostly banks who lend to the local governments. And the banks need to be recapitalized anyway. So by lowering their profits, you're simply increasing the amount by which you need to recapitalize them. So you're not really saving money, you're shifting money around. What they need to do is shift resources to the household sector.
And how would they do that? Are you talking about handouts?
Handouts is one way. The coupon program, the trade-in coupon program is another way. Paying more money to people who have retired is another way. Lowering rental costs is another way. There are lots of different ways.
So they're already starting to do a little bit of that. So you're saying ramp it up, do it large scale.
Exactly right. Because when you add up all of their programs, they're really tiny. What we need are big programs that shift income to the household sector.
All right, thank you so much. That was Michael Pettis, finance professor at Peking University. David.
Thank you.
Thanks so much, Min. Yes, stay with us. We'll have plenty more from both of those conferences in Hong Kong and Shanghai, interviews across the board. Stay with us. This is Bloomberg.
Welcome back. So in some geopolitical headlines that we're tracking today, members of President-elect Donald Trump's incoming economic team are said to be discussing slowly ramping up tariffs month by month. Now, sources say that a gradual approach is aimed at boosting negotiating strength while helping avoid a spike in inflation. Now, we're told that the proposal is in its early stages and has not been presented to Trump himself. Now, the White House has unveiled sweeping new limits on the sale of advanced AI chips by NVIDIA and its peers. Now, the rules are set to take effect in a year and establish caps on the amount of computing power that can be sold to most countries. The White House says it expects President-elect Donald Trump, is likely to maintain those curbs.
Back now to our exclusive coverage of that UBS Greater China Conference in Shanghai. Stephen Engel is there with our next guest.
Yeah, that's right, Rebecca. It is Al Gabor. He is the American Chamber of Commerce Shanghai chairman. Right?
That's right.
All right, Al. Last time we met and did an interview was the night of the U.S. election, and we all saw that Donald Trump was going to be the next President of the United States to return. Now we're just 6 days away from his inauguration. You've had a few months to digest the mood of U.S. businesses here in China. Do we have any more clarity than we did on that election night when we were there in Shanghai at the International Import Expo?
Well, maybe a bit. You know, I think we've heard from the Trump administration, the incoming administration, what their priorities are, and we know that it's very domestically focused, right? It's about keeping inflation under track and maybe bringing it back. It's about immigration. And, you know, these things are going to be first and foremost on the agenda. For businesses in China, of course, everybody is focused on tariffs. And here, you know, we don't know exactly what to expect. I read this morning that maybe there's going to be a gradual implementation of tariffs on a monthly basis, but then that was immediately refuted at the same time that isn't going to be the way it is. So I think the implication for business is you have to have a plan for the unplanned.
Yeah, but how do you allocate money to invest when you don't know what the certainty is going to be, even a month down the road?
Well, you know what happens there is you build optionality into your investment planning.
Yeah.
Right? It means you still allocate money, but you decide how much to spend, how fast to spend, how big to spend, based on the circumstances that are actually unfolding.
Yeah.
may change, some of the direction of investments. But at the same time, what we find businesses here and our members within AmCham Shanghai, they've been through business cycles before. And the question is this a cycle or is this a trend? I think the view is it's kind of a trend that we're going to have to deal with. And so they've done a couple of things to help them build in resiliency into their investment cases.
How do they plan for the potentiality of a depreciating renminbi, if that's going to happen? Already we had Han Guangcheng, the central bank governor, speak at the AFF in Hong Kong yesterday saying yuan stability is pretty important, and they're going to put in some more safeguards for that, even though the pressures are going to be mounting for the renminbi to depreciate. How do American businesses deal with that?
Well, we listen to everybody, and if you're here at the conference, you can hear that maybe we're going to see 7.5, to the dollar. That seems to be a number that people are planning for. But there's two sides of this depreciation. Right? Depreciation probably will keep exports humming for a little while. At the same time, for businesses here, it gives us a chance to finance our ongoing operations and actually to finance our investments through local funding mechanisms.
All the while also potentially taking money out. You're taking your dividends out, your profits out,
yes,
then raising funds here?
Yeah, and that's what's happening. Both are happening at the same time. Some funds are definitely leaving. At the same time, there's opportunities for local funding that's keeping things moving. And we see people making investments. In fact, the mid-cap market here is actually quite strong. And there's great opportunities now that the valuations have maybe gone to a level that's more rational than they were 5 or 10 years ago, where they were almost out of sight. Now people are looking at those mid-cap companies where they can add to their portfolio, maybe deepen their capabilities, and saying, oh, hey, now's a good time to invest in those.
Yeah. So you must be canvassing all the different sectors across the manufacturing belt here around Shanghai to find out how they are making their contingencies, the various industries. We still don't know which products are going to be tariffed as promised.
Right.
It could be 75% of all products from China. It could be 100%. It could be negotiated down. What kind of sense of certainty are you getting, if at all, from various sectors that, okay, well, maybe it won't be as bad for us, but worse for others? What are you hearing?
Well, because we don't know, you have to plan for you have to plan for almost the worst case scenario. So what are people doing? They've been working on de-risking now for 3 years or more. And what does that mean in terms of they're going through some in-depth scenario planning? They're looking at their supply chains. They're determining what they need to localize to help them be more resilient. They're looking at ways to maybe minimize sea freight dependencies, because that is an area that is actually quite vulnerable geopolitically these days. They're looking at their ERP systems, and they're saying, how much of that do we need to ring fence in China in the eventuality that we may need to have a more standalone operation in China? And so they're actually far more prepared today than they were 3 years ago, right? They're not looking forward to decoupling, but they don't know what areas will decouple.
So with 6 days left in the Biden administration, can we give it, not the post-mortem, but I guess you could call it that. Did it work? Did the policies of Jake Sullivan and others, the small yard, high fence, and the export controls on the advanced semiconductors and quantum computing, AI chips, and the like, what did that do at the end of the day to U.S.-China business relations?
Yeah, well, I think it had a major reset in the level of trust in terms of how international companies can interface in China. Now, we don't make those policies as companies, but we have to enforce them. We have to comply with these policies. And the Chinese government wasn't very happy about some of those controls that were put in place. However, companies, international companies and Chinese companies are figuring out how to coexist under this new world. And if there will be boundaries around national security from either side, the China side or the US side, the business community has been very resilient to figure out, okay, this is the place we can play.
Yep.
And to be honest, if you look at the China market today, the vast majority of the China market opportunity is not affected by these red line issues. Maybe over 70% of the market opportunity remains to be free space. And this is why for most companies, they don't look at it as something that will stop them from investing in China, but it causes them to rethink where they should play for the long term.
Yeah, they don't really have access to the playbook of Donald Trump yet.
Yeah, we don't.
So the only certainty is uncertainty right now.
Right.
So let's talk again in 6 months, okay? Or even sooner.
Well, we can do that, and I look forward to always talking about that. And I think what you find here are companies that are very resilient, that still value the China market and see it as a very necessary place, not only to produce revenue for their companies, but frankly, this is one of the most innovative ecosystems in the world, and to be excluded from that innovation ecosystem is to your long-term disadvantage. So we're in it to find a way to make it work and to do it compliantly and to do it consistent with national security.
Yeah, that's right. Al Gabor, AmCham Shanghai Chairman, thanks as always. We'll be checking back in with you
Thanks, Steve.
as we embark on Trump 2.0.
Nice to see you.
Nice to see you. Okay, that's a wrap from the UBS Greater China Conference 2025, the 25th anniversary. We'll be back next year, I promise.
Yeah, there we go. And certainly more conversations there with Steve and the team. Fantastic work there on the ground in Shanghai. And for our Bloomberg clients, of course, and I know we say this almost every day to catch the fantastic interviews you might have missed. We mean that more days, a lot more than others. I mean that, but I really mean it today. Check out all the fantastic interviews you might have missed across all the coverage across these banking conferences in the Asia Pacific on the Terminal TV Go. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show. Here is, to be honest, something that I really wasn't expecting. Talk about this generation's iteration of import substitution, given the tariff story, right? So there is this sort of pivot in traffic and users, against the prospect, of course, of TikTok being banned, and this sort of migration towards, well, the English is Red Note, is Xiaohongshu, which is Little Red Book, of course. And a lot of the stocks related to the company are seeing a massive pop. One-day gains, limit up, as you can see in most cases on your screens right now, on the back of news here and this pivot from sort of one platform to the other. Now, in case you missed it, the other piece of news here, pretty major as well, is that China is said to be mulling a sale of TikTok in the U.S. to Elon Musk as one possible option. So put those two geopolitical stories together and you get what you're getting as far as market goes. Right. Some other things to track here going into the rest of the Tuesday session as we wrap up, I guess, the better part of the morning session here. We are in the window for credit numbers to come through. It could come today. We have 1 or 2 more days, of course, for this to come through. December numbers, keep in mind. In the next hour, we'll have more information on this 30-year bond auction. So this is very, very simple. 30 billion bonds, UN bonds in 30 years. So we'll see what that looks like. And, of course, speaking of threes, 3 p.m. local time is this briefing taking place between monetary officials on really more economic support. Markets are rallying on the back of that and vows from the CSRC to support this market. 10-year yield is flat. Yuan is stronger. Plenty more ahead. This is Bloomberg.